So, 842, as Mike mentioned, we've all hopefully been battling with 606, and now moving on to maybe bigger and better things in 842, the lease standard. And here you'll see the effective date. So if you're with a public company, I'm assuming that you came to it because of the free breakfast, because the standard is already effective. For our private companies, it's effective 1/1 of next year, with the interim periods being the following year. So you have a whole another audit cycle, so to speak, before you'll be reporting under 842. So of course, the lease standard, the big change here is that essentially everything becomes a capital lease. So previously your operating leases were just down in the footnotes, now it will be up on the balance sheet. So substantially all leases get recorded, right to use asset, corresponding lease liability. The income statement is substantially consistent with the prior, as well as lessor accounting. So really going to focus mostly on leasee accounting, because lessor accounting doesn't have a whole lot of changes. And of course, originally you could only do the modified retrospective method, but early last year, there was a change to that through ASU, where you could do a cumulative catch-up adjustment. So essentially, when you implement this standard, if you have comparative financial statements, you have an option of when you're going to apply the standard. If you go with the cumulative catch-up, then you will not restate the prior period. You'll have an opening retained earnings adjustment as of the most current year, but the prior year will all be under the old standard, under 840, as well as all of your disclosures will follow. So why do we care? Aside from having to comply with GAAP, we want to issue GAAP financial statements, which is always a plus, right? We want to comply with GAAP, but really covenant compliance. So there could be a very big impact on covenant compliance. Hopefully you've already been talking to bankers and getting those reworked if we think it's going to have a big impact. If you have any new arrangements that you're entering into, those should be considered. I have heard from a number of preparers that they're looking to put covenants in there with language that say, for new arrangements, that say something to the effect of using GAAP at the existing GAAP at the date that they sign it. So they don't necessarily have to deal with the impact when they sign the new arrangement. That's really obviously up to you and your lender, if that will go through. I'm not going to bore you with the middle section there on all the processes that you're going to have to go through and significant judgments and things like that. So as you implement a new standard, obviously there may be changes that you have to make to your internal control structure, so forth and so on. But other arrangements, we shouldn't forget those things that aren't necessarily covenant lending institution related. Those are the easy ones to think about, but there are other compensation arrangements or anything else, earnouts, buy-sell arrangements. Really any arrangement that you have that has any sort of metrics associated with it could be impacted. So that's the why. So there is an exception. So the first question I always get is, okay, there's a new standard, how do I get out of it? Right? Well, there's an exception. To get out of it, it's the 12-month short-term lease exception. There are some common pitfalls here, though. What you have to be careful of is those two items there. Purchase option, so purchase option automatically will take you out of it, and renewal options, so you can't go in and just have a 10-year lease and say, okay, I'm going to do a 1-year lease with 9 one-year renewal options. Aside from the fact that your landlord would never allow you to do that, or whoever is the lessor, the standard won't allow you to do it either, because the renewal options, if they're reasonably assured, they have to be considered in the lease term at the time that you make your assessment. Meaning that if you are in that scenario, you likely would say that those renewal options, you're going to exercise them, and you'll pull it into your lease term, and you'll no longer be less than 12 months. That's how it gets looked at. So that's a common pitfall. The less than 12 months is somewhat of a rare exception to apply. Thinking about this from a process flow standpoint, we'll walk through each one of these areas, some of them briefly, some of them in a little bit more detail. Obviously, given the time, can't necessarily get into everything in a significant amount of detail, but my contact information is in your packets, so by all means, after this session, if you think of anything, call me, more than happy to help. So these are really just the steps that you go through in your gap analysis. Here we have the first step is defining whether or not your contract contains a lease. I'm not going to go through each and every one of these. There's actually a really great flow chart within the implementation section of the standard itself. So if you go to the 55 topic, the very first paragraph has this really wonderful flow chart that you can go through. It has links to what each of these things mean, because as we know, gap is not always intuitive. Just because it says something like explicit or implicit identified asset, there's pages on pages of what that actually means. What's important to know is there's an evaluation, and it's an all criteria, so it's got to meet all of these items. And it's a two-pronged test. So you have to have an identified asset, and you have to have all three of these. And then the customer, the leasee, has to control the asset, which has those two elements to it. And again, following through that flow chart will be really helpful and show you where the pitfalls are. There aren't expected to be too many situations where you currently have a lease and will not have a lease under the new standard. It might be the other way around, unless, of course, power plants may, if anybody has power plants, they may come in or out of the lease standard depending on this. But not really the area that's going to require a lot of judgment there. So the next step is determining, does my contract have what the elements, the components of the contract, and separating those out. So you have lease components and non-lease components. And essentially a lease component are those elements of the arrangement that provide the customer with the right to use the identified asset. So it's any part of the contract that relates to the underlying asset itself. For instance, if you enter into an arrangement where you're going to lease a truck and you're also going to hire a driver from the lessor, the truck is an asset, a human is not an asset, so you have the identified asset being the truck, that's the lease component, and then non-lease components are any other components that are not lease components, essentially. So in that scenario, you've got the truck is the asset, it's a lease component, driver is a non-lease component. Another very common example, probably what all of us would see, is in real estate. So you take a section of the building, right? I have the floor, the whatever section of that building, and then I also pay CAM charges. CAM charges are the non-lease component portion of it. And you can see that listed up there. Once you've separated your components or you've determined your components, you're now going to separate them. This is going to be very 606-like in essentially determining what you separate out. It doesn't use the same language, so it doesn't get into distinct or any of that, but it essentially is very much like a 606 analysis. And then the allocation of the total consideration will go between the lease component and non-lease components, again, in a very 606-like analysis where you're doing on a relative standalone price. What's important to note here is there's some practical expedience. And throughout, I'll touch on the practical expedience, and I'll also wrap up with the practical expedience. So there are a couple of policy elections that, as preparers, you have the option to make. This is one of them. So a leasee has the option by asset class to essentially bundle the lease and non-lease components. If you do that, what it's going to happen is it's going to increase the right to use asset and the liability. So you have to know what the consequences of that bundle are, and it's irrevocable. So you're going to have to do it and consistently apply if you take that practical expedient. For a lessor, this was really important because they were looking at it and going, okay, well, I've got to separate between 606 on the CAM charges and 842 on my regular lease. So the FASB, sometime last year, issued this pronouncement that allowed them to take, under certain circumstances, there is an evaluation in order to be made. It basically says if it's the same pattern of revenue recognition, but it's the same pattern of recognition, that you can bundle those components. Very, very important for a lessor. If we're just talking about a plain vanilla lessor-lessee relationship, from the lessor standpoint, we just have lease payments and CAM charges, likely this is going to be a very good option. Are there any questions before I go on? Because I know there's a lot of content and staying very at the surface.
So why would someone bundle it with just the simplicity and accounting for it?
Exactly, it's simplicity. It's 100% simplicity. So I mean, going through and determining during standalone selling price and determining the allocation might be more hassle than it's worth at the end of the day. But it's important that you go through and you understand what the consequences are of doing so. Personally, I think that these practical expedients were they're true to their name. They're practical and helpful. So hopefully they will make the burden of implementation easier. So after you've gone through and essentially determined your lease components, your non-lease components that you do have in a lease, you really need to think about inventorying, because there are a couple of items here that are very important for the rest of the analysis of determining classification, measurement, so forth and so on. So you start with the lease term, which we talked about before. This is going to come into play both in determining what you're recognizing and also the classification. First, in the classification, exactly what you do now, meaning operating or finance lease from a lessee perspective. Finance lease is essentially like what we today know as a capital lease. So lease term, as I said before, you have the leasee options that are reasonably certain to exercise. You got to pull those in. So if you got a 5-year lease with a 5-year one option that's also 5 years, and that's reasonably assured that you're going to exercise it, you have 10 years in your lease term initially that you're looking at. The determination of whether it's reasonably assured is very similar to different words that are used in the master glossary for determining that, but it's very similar to what we look at today. And it doesn't use the same words of like economic detriment or anything like that, but it's very similar in how you get there. But important to consider. Renewal options that are at the lessor's option, well, if they're favorable terms, then they're going to take them, so you would bring that in. And then here you've got a little bit of math, right? So I think the important thing here is if you have any variable lease payments, those would get pulled into your total consideration to the extent that those variable lease payments are tied to an index. So very common, you'll have escalations based on CPI. So you'll take those in based on the CPI that's in existence as of the date that you execute the arrangement. Other types of variable consideration that are not indexed, common to Rob and Ron, would be situations where it's sales-based, where the variable lease payments that you make are based on the volume of sales at that location. And then some other less common areas. The discount rate. This has become a real hot topic. So for a private company, you have the option to, another practical expedient for your discount rate, rather than going through and determining what your discount rate is, you can use your risk-free rate, very similar to like a Black-Scholes. Use the risk-free rate for the time period that corresponds to the lease term. Again, from a consequence standpoint, by doing this, you have a lower discount rate. It will increase your right-of-use asset and your liability, and therefore potentially make you trip one of the tests for getting to financing, at least, which we'll talk about in a second. As a matter of practicality, the level of effort that goes into calculating your incremental borrowing rate, private companies have this option, public companies do not. So the level of effort that goes into determining your discount rate could be very, very significant. Not going to necessarily go into it. What I would say is just remember that there's a lot that goes into determining it. It has to do with the difference between it being an uncollateralized rate under the old standard and changing to a collateralized rate under the new standard. After this, Google, just writing in Google, put calculating discount rate under 842, you'll get a wealth of information, it'll make your head spin. It took me probably an entire day to get through every single thing. I mean, it starts to get consistent after a while, but there's a lot to it. So if you can, I would elect the practical expedient to use the risk-free rate. And where this is going to come in is determining essentially the initial measurement of the right-to-use asset and liability.
So you think it would be a challenge for an outside accounting firm to accept your incremental borrowing rate? You'd have to get comfortable with that, right?
So first, determining whether the rate implicit in the lease is going to be nearly impossible. Everybody's going to likely go to the incremental borrowing rate. So yeah, I think that there's a lot of judgment that goes into that, and there could be a cost that that could not be seen as beneficial. Not to mention that you're going to have to maintain that, right? So you're going to have to continue, every time you enter into a new lease, you're going to have to recalculate the incremental borrowing rate. So this is a practical expedient that allows you to use the risk-free rate. I mean, obviously, certainly we would love the work, so we can help you with this. Not trying to, put myself out of business here, but there is a lot that goes into it. So lease classification, you've inventoried everything, you know what your lease term is ultimately going to be, what the elements are going to be that go into your lease payments, and you've calculated your discount rate. So now you're ready to determine classification. The first 4 items are substantially consistent with the tests that you perform today to determine operating versus capital. FASB in their infinite wisdom, they've changed the third test, which used to be referred to as the 75% test, is no longer called the 75% test. Now they call it a major part. And then in the implementation section, they say, yeah, but you can pretty much rule of thumb use 75%. So, and then they do the same thing to us in the 90% test, which is the 4th one. So they change the word, but then you look at the practical part of it, and they say, yeah, okay, 90%. So that's what substantial means. There's a new one there, the 5th one, which basically says that there's no alternative use to the underlying asset to the lessor. So example of this, I've seen a lot of examples on looking at pipelines. I'm not going to use that one because it's probably low. Think about Mercedes. They lease a machine that basically makes their hood ornaments. There's a die cast that's associated with that machine that they've made an adjustment to the machine that cannot be replaced. It's only useful in Mercedes, and if the lessor has no use for this machine other than to make Mercedes emblems. Therefore, it now meets that 5th criteria. Because the asset in of itself is worthless to the lessor. Are there any questions on lease classification? So at this point, you determine operating versus finance formerly known as capital. So we're ready to calculate the right to use asset and the lease liability. First calculate the lease liability because it's the first part that goes into the right to use asset. The present value of the future minimum lease payments, so those lease payments that we determined before, you take them at their gross, you present value them, that's your lease liability. The discount rate is whatever you used before, whether you took the practical expedient or that incremental borrowing rate. And that will get recorded at the commencement date as a liability. On the right to use asset side, you start with the liability and you add to that any payments that were made prior to the commencement date. So if you prepaid, that wouldn't go into the lease liability, but it would go into the asset, right? It wouldn't go into liability because you prepaid it. You don't have a liability. But it does go into the asset side. Direct costs. Direct costs is anything that is direct and incremental, so very similar to what we think of today. So and we'll have a slide on it in a second, but in essence, if you've got somebody on staff that you were going to pay anyway, their salary doesn't go into it because it's not direct and incremental. But if you paid all the legal fees, a commission, whatever it is, that's direct and incremental. It would go into direct costs. And then any landlord incentives that you get, like say you do a build out, you got $50,000 as an inducement to get into the lease, you would reduce the right to use asset by that landlord incentive of the 50 grand. And that's how you would recognize it on day one. Here, as I said, these are some examples. As I mentioned, commissions, legal fees, excluded employee salaries, so forth and so on. So this is in your handouts, but essentially your indirect costs, just an example of some things to think about, include or exclude. So after day one accounting, what do you do? So it depends whether we're looking at a financing or an operating. So your day one, your accounting is the same. Day two and beyond is different. For the finance lease, i.e. what we used to refer to as capital, remember they're now both on the balance sheet, but what we do with it and afterwards changes. The right to use asset, for the finance lease, you'll amortize that on a straight line basis. And then the lease liability essentially is like any debt arrangement, you'll get rid of that through like an amortization schedule that includes interest. On the operating side, it actually gets a little more complicated, not that it's overly complicated, but a little bit more complicated. It has to how you amortize the right to use asset. Essentially what you do is you first calculate straight line rent, like you do today. So if you have $1 million that you're going to pay over 10 years, you have $100,000 of expense per year. You calculate your amortization schedule to get your interest expense like you would any other type of lending arrangement. And the difference between that $100,000 and the hypothetical interest expense will be your amortization that brings down the right to use asset. That interest expense is, in the operating scenario, is phantom though. It's just for purposes of mechanics. You will not have interest expense like you would on a finance lease. And we're going to go through an example of that in a second. And the lease liability is the same, right? Because it's the amortization schedule. It's like it's debt.
Question, sorry. How many leases are really coming from operating over to finance? When the standard first came out, it's like, okay, all leases are now going to be finance. But you talked about the two criteria still being roughly 75 and 90 behind the scenes. So what's the real driver then? Or is it just a more literal interpretation of those words versus the percentages?
Yeah, so I don't think that once you apply it that you'll have a whole lot of differences unless you hit that fifth criteria that is there. On the onset, there's another practical expedient, the package of practical expedients, which we didn't get to yet, which essentially if you elect that, then you just carry over your current classification on transition.
You also appreciate the asset, right?
Sorry?
You have to appreciate the asset. Right?
Yes.
And what happens if you don't end up keeping the asset at the end of the lease term? You return it.
Oh, the asset,
Sale,
yeah, but the asset at the end of the term would have been fully amortized.
Yes. It has, and if it's not fully depreciated, you have to record a gain or loss, right?
Yep. So, so I guess the answer is I don't necessarily see a whole lot of differences. Before, when I mentioned that it's essentially like everything's becoming like a capital lease, it's really because everything goes up on the balance sheet. You now have a right to use asset and a lease liability. It doesn't matter whether you're finance, operating, lease, it's all up on the balance sheet. It's really just a matter of the subsequent measurement and how it gets amortized out on the asset side, and the classification or presentation on the income statement is the real difference.
Are you going to talk about, or maybe you should, I know it came up a question for a client we had, what happens to the existing straight line or deferred rent asset or liability you might have had on your books prior to this determination?
Can I answer your own question?
Yeah, so I think one of the prior slides mentioned that your right of use asset would get increased by prepaid rent. That would also include whatever deferred rent asset, or it would be reduced by your deferred rent liability that you have on your books.
So just an example here, we're going to go through for finance first, but hopefully we don't have any escalations that are $100,000 per year, but the numbers work really well, so that's what we did. But fact pattern area of 2, 3, and 400, discount rate 5%, not necessarily going to the calculation, it just is 5%, you get to 808, is the present value of your minimum lease payments, and incremental cost that you paid beforehand was $30,000. So how are we going to record the right to use asset? Finance lease, you'll see that you have 838 is your right to use asset first because it's the present value of the minimum lease payments plus the $30,000 that you previously spent. And the 808 is the liability side. So that's what you'll record on essentially day one accounting. And then this is how you would amortize it. So notice here, your right to use asset is getting amortized under a finance lease on a straight line basis. So 838 divided by 3, presumably, once upon a time I checked this math, I'm hoping it actually works, but that gets you your right to use asset amortization, and then your liability, you'll see, works exactly like an amortization schedule as if it was debt. Anybody checking my math? So you'll see the payments, 2, 3, 400, you have the interest that is recognized there, and then the delta, just like you were paying off debt, goes to reducing your lease liability. So in summary, from an income statement standpoint, you have interest expense, you have amortization expense, you see that it's higher in year one and kind of goes down, that's what you'll see. And then here are your cash flows, so 230, that's your 200,000 plus the 30,000 incremental direct costs that you paid, and 300, 400, so that all works out. But you still get to the same 930 over here, it's just how it ultimately got amortized out. For our operating though, as I mentioned, first thing that you have to do is calculate your straight line. So this is just pure straight line, it has nothing to do with the right to use asset, this is just my payments, my gross payments, 2, 3, and 400, divided by 3, gets you to 310. Again, hopefully my math is accurate. And you'll note in this blue box down here, this is sort of like my little disclaimer, because as I was going through it, it made it sound like there was an actual interest component, but this calculation is solely for function of determining how to amortize out the right to use asset. There is no interest expense under a operating lease. So what you do first is you calculate your amortization schedule to determine your lease liability. And you'll note that that is exactly the same as it was under the finance lease example. For the right to use asset side, so you have your straight line expense, so that's what you need to get to, 310. You take out the interest expense that you calculated on the other side, and that's the amount of the right to use asset that will ultimately get amortized. That's how you calculate it out. So really, this is, I mean, it looks like an Excel spreadsheet. You do it once, you pull it down, and it will calculate it out for you. Again, it says interest and amortization. That's really just to show you the components there, but it all gets recorded as one line item on the within operating expenses.
Joe? So, that line item, though, that they recorded, it's not considered rental expense, correct? It's considered operating lease expense or something like that? So it's similar, but it's different.
Yes.
P and L hit, in this example, versus the current law. Am I, comes up at 310,000 in this law, and in the current law, would it still be $310,000?
Yes.
So same as that.
For
for P&L?
operating, yes.
So just straight line, it really just straight line the lease, put it on the balance sheet, but the expense ultimately is the same. This whole new, with all this.
Yeah, but it puts your asset up on the books.
Right. But it's,
Can you just clarify what Mike asked? So this is semantics, like when you're
Yes.
talking
Yes.
rent,
It's semantics.
I mean, it's really rent.
Uh-huh.
I mean,
You know, potato, potato,
okay,
yeah,
call it rent. Call it spade a spade.
yes. From a classification standpoint, it all hits the P and L in the same location as it always did.
Okay,
So what the nomenclature is at the end of the day is same as, you know, whether we call it a major part or a 75% test.
So instead of having a deferred rent on the straight line, your liability account is going to be managing the 310 versus the, right,
Yeah, so if we're talking about operating, the liability,
operating.
yeah, so your 310 doesn't change. It's really just that the amortization that we were talking about over here, this $40,000 component, comes out of your 310 to tell you how much of the right to use asset to amortize on a period by period basis. So it all does is reduce your balance sheet, but this amortization charge is part of that rent line item. It's not called amortization, it's not called interest. Finance, it is.
So your balance sheet is going, your asset is going down by 269,
It's, yes,
and your expense is going to be 310,
correct.
and the difference is 40, which is your